Hello students, welcome to day 18 of Mathematical Theory of Interest course. In today's discussion, we will continue the topic that partially we have covered in day 17. So yesterday we basically discussed about the stocks and the financial markets. About stocks we discussed that the stocks are called the shares or the investments in owner's equity of a company, and the financial markets are basically the markets where we can buy or sell these shares. So in yesterday's lecture we discussed in detail what are the important components, what are the important bases, what are the important terminologies that can be used in buying and selling the shares from the financial markets. We discussed in detail the flow chart, which was explaining the total process of purchasing or selling the securities, and we have also discussed the important terminologies which can be used regarding the prices, regarding the index, everything. So today we will continue our discussion. So in today's class, first of all, we should know, we will just at the start we will define the financial market. A financial market is a market in which people and entities can trade financial securities, commodities, and other fungible items of value at low transaction cost and at prices that reflect the demand and supply of these particular securities. This is a very comprehensive definition of the financial securities. In short, we can say that financial market is a market where financial assets are being traded. Just like fruit market, in a fruit market, what is being traded? The fruits are being traded. In vegetable markets, vegetables are being traded. In car market, cars are being traded. In mobile market, mobiles are being traded. Similarly, in share market, shares are being traded. Or in financial market, the financial assets are being traded. What kind of securities are being traded in the financial market? These securities include bonds, stocks, and commodities, including precious metals or goods or agricultural goods. These are called the securities. Basically, the financial market fulfill very important functions in the economy of every country. These are basically used to raise the capital of the capital markets. They are basically play a very important role in transferring the risk from one person or one party to the other party. The financial markets are basically play a very important role for the price discovery, and global transactions are being with the integration of the financial markets. The financial markets play a very important role in the transfer of liquidity in the money market, and they are also play a very important role in the international trade through currency market. So basically, the capital market, derivative markets, money market, and the currency markets are some alternative names of the financial markets, or we can say that they are the branches of the financial markets or different types of the financial markets. Based on the whole discussion, we can have certain types of the financial market. First of all, capital market, we have commodity market, we have money market. The capital markets. Capital markets are basically those financial markets where long-term assets are being traded. Long-term financial assets are being traded. This is called capital market. The stock markets, it is also called it has two further categories, stock market and the bond market. Stock market is a market which provides financing through issuance of shares or common stock and enable subsequent trading of these shares. Bond markets is that capital market which provide financing through the issuance of bonds and they enable subsequent trading thereof. So a bond market is a market where bonds are being traded, and a stock market is a market where shares are being traded. Second category of the financial market is the commodity market. It facilitates the trading of different kinds of commodities. These are precious commodities, just like gold, silver. This is the market. Money market. Third one is the money market. Money market is a market which provides short-term debt financing and investment. By means short-term financing, we means less than 1 year's financial assets are being traded in the money market. Less than 1 year's financial assets are being traded in money market. Next one is the derivative markets, future markets, insurance market and foreign exchange markets. Derivative markets are basically those markets which provide instruments for the management of financial risks. In derivative markets, basically this is the risk management market. We can say that this is basically the risk management market. The parties involved in the derivative market, they are sharing or managing their risks with each other. Then we have future market, the market where future financial assets are being traded. What is meant by future financial assets? Just like forward contracts and future contracts. These are those financial instruments in which we can get our investment back, or in which the transaction is being done in any future specified date, but parties are agree at today's time period. These are called future markets. Then insurance market. It basically, insurance markets are those markets which facilitate the redistribution of various kinds of risks. They may be financial risk, they may be non-financial risk, or some other kinds of risk. Then we have foreign exchange market, in which foreign currencies are being traded, which facilitate the trading of foreign exchange or foreign currencies. The capital market is the most important market. The capital market is the most important market in this whole scenario. The capital market may also be divided into two further categories, primary market and secondary market. A primary capital market is that market where first-hand capital securities are being traded, or we can say that where first-hand market securities are being issued is called primary market. And a secondary market is that capital market where already issued financial securities are being traded. So it is a very easy to differentiate between primary market and secondary market. Primary market is simply the market where issuance of share is done, and secondary market is that market in which trading of the capital financial assets are being done. Trading is done in capital market, secondary market, and issuance is done in the primary market. So basically, newly formed issued securities are bought or sold in the primary market, such as during initial public offerings. This is called IPOs. Secondary market allows investor to buy or sell existing securities. It means the transaction of these securities are being done in the secondary market. The transaction in the primary market exists between issuers and the investors, and while in secondary market the transactions among the existing investors being done. Money market. Money market become a commodity market. The money market become a component of the financial market for assets involved in short-term borrowings, lending, buying and selling with original maturities of 1 year or less. So money market is more liquid as compared to the capital market. The market in which less than 1 year's maturity time period securities are being traded is called money market. Trading in money market is done over the counter. If the it is called the wholesale. There are certain functions of the money market. The transaction of large sum of money normally done in the money market. The transfer of parties with surplus funds to parties with deficit. It means that deficit financial unit and surplus deficit economic unit and surplus economic units are being satisfied in the money market. It allows government to raise funds. It helps implement monetary policy. It determines the short-term interest rates. These are the very important features of the money market. Now next one is the common instruments which can be traded in the money market, or we can say that these are the common money market instruments. First one, certificates of deposits. Second one is the commercial paper. Third one is the treasury bills. Certificates of deposit, these are basically called the time deposits, which commonly offered to the customer by banks, thrift institutions and the credit union. Commercial papers are also the short-term promissory notes issued by the company at discount to face value and redeemed at face value. And treasury bills are basically the government securities. They are short-term debt obligation of a national government that issue to mature in 3 months to 12 months. There are differences of the money market and the capital market. We can differentiate money market and capital market based upon time to maturity, based upon credit instruments, based upon nature of the credit instruments. We can categorize the money market and the capital market. The money market, in money market, the time to maturity is less than 1 year, and in capital market, they have time to maturity more than 1 year. Credit instrument, the main credit instrument of the money market is the call money, collateral loans, acceptance, bills of exchange, while the major instruments of the capital markets are the stocks, shares, debentures, bonds, securities of the government. And according to the nature of the instrument, the credit instrument dealt within the capital market are more heterogeneous than those in the money market. Some heterogeneity or credit instruments is needed for operation of the financial markets, and it has too much diversity. It gives too much diversity, which creates problems to the investors to take efficient decisions. The institutions, we can also differentiate money market and capital market based upon institutions. Just like important institutions operating in the money market, they include the central bank, commercial banks, acceptance houses, non-financial institutions, bill brokers, etc. While in case of a capital market, stock exchange, commercial banks, non-bank institutions such as insurance companies, mortgage banks, building securities, they are the important institutions which deal in the capital assets, capital financial assets. The purpose of loan in the money market is to provide short-term debts to the business, and it provides working capital to the industries, while capital market on the other hand gives the long-term investment to the industrialist and provide a fixed capital. to buy land or machinery. We can also divide based upon the risks. Obviously, in money market is a short term. In money market, we trade short term instruments, so the risk factor is small in case of a money market, and in case of capital market, the risk is high. The basic rule for money market is that the liquidity adjustment. We can adjust our liquidity in very easily in money market, while liquidity adjustment in capital market is becomes difficult. The money, according to the relationship with the central bank, money market is closely and directly linked with the central bank of the country, because it is more liquid as compared to the capital market. While capital market feels central bank's influence, but mainly indirectly and through the money market. So this is all about our today's discussion. If you have any question, you can ask me anytime. Thank you so much. Bye bye. See you in the next class.